Well, the markets see gains for the second straight week, with the frontline indices gaining 1% each, except IT and FMCG. All indices posted gains. Hello and welcome to yet another edition of the Editors Roundtable. Over the next 30 minutes, we decode the week gone by. We tell you why Indian IT stocks fell, and we put the spotlight on the broader market correction. I'm Sonia Shenoy, and today with me there's Nigel, there's Nimesh, and of course we have Nilesh Shah with us here in the newsroom as well. He's the MD and CEO of Envision Capital. Folks, it's been a very interesting week, right? Of course, the Nifty had its to and fro, but by the end, it ended above the 22,000 mark. We managed to close in the green, a better time for the mid-cap index. So all in all, not too bad.
Well, that's right. I think for this week, though, volumes were at least 20% lower than what we've seen on an average in the previous few weeks. So the moves were on low volumes. 21,700 people are saying it's not going to be a good close. It was a good close, actually, to the week.
And the good part is we've seen a good recovery, right, in the broader market stocks. So there is a bit of a relief as well for the portfolio investors. They've seen some sharp falls in the first 2 weeks of March. The portfolios were down 20-30%, and now we've seen a bit of a recovery as well. So a bit of a good week from a portfolio investor's point of view as well.
Absolutely. Nilesh, how are you feeling about the market now? Because it was a good week, but we had a big scare last week as well. Do you think the worst of the volatility is not over, especially because now we had some bad news in the form of the IT stocks, the Accenture guidance cut? So do you think there's still more to go in terms of volatility?
Maybe volatility might still be there. There have been very large pockets of the broad markets which have corrected and corrected quite steeply and meaningfully. Some of them have corrected by maybe 20 or 30%. So I would probably say the froth is out. I mean, I don't think this market has froth. Maybe a bit of it still there in some pockets, but by and large, I'd probably think a lot of the downside has already kind of played out. You could probably see some bit of consolidation, and then of course come April, May, it's going to be over to the earnings season.
This is going to be music to the ears of a lot of investors, right? That the big pain is out of the way. So I'm sure a lot of investors will like this. But we should play this on Monday, Tuesday, every day of the next week.
Well, next week is a truncated week,
so
and there's no Monday. It's straight away Tuesday, right? Next week.
Correct.
Okay, but let me just quickly, in case our viewers missed out on the week gone by, let me just tell you how the week played out. So, you know, this week the Nifty ended above the 22,000 mark. The mid-caps actually had a good week. It was, the index itself was up almost 1.5%. And the two pockets that did quite well this week were auto and real estate. Both these indices were up about 2% this week. In fact, if you look at the biggest gainers list, right, there was Maruti, Bajaj Auto, Eicher Motors, all three stocks up 6 to 8% this week. There was a lot of positive information as well that came out. CNG demand has gone up. Maruti closed at a record high this week. Then you had the EV policy that came out. So a lot of beneficiaries there in the auto ancillary space. On the flip side, though, IT stocks fell up to 3% after Accenture cut its guidance. Now, next week is a truncated week, only 3 working days, and the volumes will definitely be on the lower side, but we'll be tracking a lot of the companies. Nilesh, you've tracked IT for decades now. What have you made of the Accenture guidance cut? And, you know, an investor who has positions, say, in Infosys or TCS, what should they do now?
Well, honestly, the Accenture guidance is not very surprising. I clearly believe that it's going to be very challenging for some very large outsized IT services firms to continue to grow at a meaningful pace. You probably still grow in low single digit, mid single digit, but it's going to be hard to kind of grow beyond more than, say, 10% or so. I think the biggest challenge for them is that, yes, while we all have been talking about AI, robotics, automation as an opportunity, but the bigger challenge is that what a project which took, say, 500 people to execute will probably now take 100, 150 people. And that will, to some extent, blunt or diminish the prospects for the big boys. And it's quite possible that a lot of the business could shift to the smaller companies who are more efficient, who probably have better domain knowledge and can manage a smaller team much more effectively and better more solutions to enterprises in the developed markets and the developed world. I think that's the reality, that's the hard fact, which will imply that going forward, they'll have to gravitate towards a lower growth rate versus what it has been for the last 5 or 10 years.
Okay, in fact, I think Nigel has put together some data as well. Nigel, over to you.
Well, you know, the IT stocks, the IT index itself was as is underperforming for this month. And this Accenture news has come as a bit of a knockout for them, you know, because clearly the commentary, the guidance, everything was quite weak. So you pull up a chart, you'll see the Nifty is more or less flattish for this month. But all the IT index itself, as well as all the stocks, they are sitting with cuts of around anything between 5 to around 10% approximately. What's the problem? Accenture, they went ahead and they lowered their guidance, whether it was on the revenue growth, whether it's on the organic growth, or even the margins. Now they're talking about achieving the lower end of the range. So that's the problem pocket. Why did they do this? Because they're saying that the short cycle discretionary projects, well, they're expecting cuts out there. Point number one. Though they also went on to mention that clients continue to prioritize the large scale transformations. In the longer term, the people are focusing, the clients are focusing more on that. But discretionary spends pull back, that's a problem. Why does it impact Indian IT companies? The markets, they were factoring in double-digit growth for Indian IT companies in FY25, which now is in doubt. The other point is that Accenture also said the outsourcing revenue growth could be in mid-single digits in the coming year. So that's the problem as well. And now this entire recovery that we were talking about, there's a question mark being raised on that. Kotak, they put out a note. They're saying that, part of the sheet was factoring in discretionary spends uptick, particularly in companies like Infosys, Wipro, LTI, Mandri, which may not happen. So that's why, though the sector will get hit, but these few companies could get harder hit. And also CLSA, they say that IT remains an earnings downgrade cycle. And this earnings downgrades, well, it's not been factored in to current prices. So as you said, Nilesh, I think the preference is for the smaller cap, the mid-cap names in comparison to some of these large cap names, right?
Oh, absolutely. Absolutely. I think companies which are focusing on engineering services, R&D services, providing solutions around software-defined vehicles, communication, SATCOM, maybe chip design. These are clearly the pockets which are growing at a much faster pace. You're not dealing with enterprise-wide solutions, but you're dealing with very specific solutions in which many of the cases they could be time-critical, mission-critical, and therefore the providers of those solutions could essentially have better pricing power and therefore better margins, and you will really get paid well for your domain knowledge. That I believe is the opportunity, and those are the kind of companies which will probably grow very comfortably in double digit, probably maybe more like closer towards the 15-20 odd % versus the big boys which probably would struggle about growing at more than say 5%. So the growth differential is going to be huge.
Nilesh, you spoke about the mid-cap IT doing slightly better than the large caps, but what is Oracle doing right for the stock to double in 3 months' time? It's been a big outperformer in the IT pack. First, do you hold that stock? And if not, or yes, whatever, what's working well for Oracle?
Yeah, don't own it. Don't own it. But yeah, so this has been a giant which has come out of the slumber after a decade.
Yes.
Okay, it's for 10 years you don't do anything, and suddenly the 11th year you wake up, you stand up and do well. Of course, to give credit to them, they seem to have backed some nice contracts.
True.
But the entire BFSI space, especially in the BFSI space where you're able to transition, transform, and start to adopt AI. So if you look at the entire BFSI space, not just Oracle, there's Intellect, which is doing well, Newgen, which has done well, Nucleus Software has done well in patches, 1 quarter here and there, but overall that pack is doing well. Especially the kind of companies which are able to provide AI-oriented solutions, I think they're doing better. I probably think Oracle is just a beneficiary of that. One has to see, maybe this will last for another quarter or two, but one will have to wait for probably a slightly more longer time to really figure out whether this growth is for a longer period or it's just a flash in the pan for a quarter or two.
Nilesh, I also wanted to ask you, at the start of the show, Sonia mentioned about the truncated week. We have mentioned that a couple of holidays as well, and clearly all the editors are not in. There's this big travel and tourism and leisure travel that's getting a push. Some of those stocks, whether it's hotels, aviation stocks, all of them have done very, very well. How much is still left on the table?
I still think a lot is left. I think for the markets, the reality is that valuations are not a challenge, or stock price run-up is not a challenge, as long as you can demonstrate growth. Even when you try and do a booking, there is no letdown in prices. There's full occupancy, prices are still strong, and a lot of the hotel companies are at least changing the business model, getting more into management contracts. It's an asset-light model. So I think across the board, travel, hospitality, leisure, entertainment, that entire pack, I still think has strong tailwinds. I don't think we're nearing an end very soon.
So hotels and then aviation stocks, that would be the pecking order?
I've traditionally not been a fan of aviation as a sector, so I honestly don't know. I don't track it. I don't intend to own it. But I think hotels, hospitality, resorts, I think that's a great place to be. Lots of things to pick and choose from.
And not only are the stocks a great place to be, but the hotels itself are also a great place to be, right? Especially this long weekend that's coming up. But okay, I want to ask you about the auto stocks as well, because they were big gainers. But I'll give you some time to, ponder over that. In the meantime, the small and mid-cap indices have seen a sharp reversal this month. Portfolios on an average are down 20 to 25% for many investors. The key question we're asking today, is the correction done or is there more to go? Nimesh, you put together some thoughts.
I'll put some data, but of course, Nilesh will be better to say whether the correction is done or there's more to go. So what has mid-cap and small-cap done this year? If you look at, let's look at for this year. Y2D, the returns are very, very flat. If you look at Nifty mid-cap, small cap, or for that matter, micro-cap, just 1% return. But from the peak, the mid-cap index is down 5%, small cap and micro-cap indices are down 10% and 11% respectively. So there has been a big fall. But if you just look, just put into context as to what these indices have done over 2 years and 3 years, that shows a different picture. Mid-cap index over a 2-year period has given a 63% return. Look at this, 63% return over 2 years and over 100% return over 3 years. Small cap index in 2 years given 45 and over 3-year period has given 82% returns at an index level. And micro cap index in the last 2 years has given 86% return. So it's been a big move in these indices in the last 2-3 years. So, but the street seems to be quite divided at this point in time. I've just looked at some brokerage notes. For instance, HSBC, they believe that this correction, what we've seen in March, is unlike to what we saw in 2018. Things have become much more better. The macros are much more better than what it was in 2018. So they do not expect a sharp 20-30% kind of drawdown from these levels. So that's HSBC note. If you look at even Jefferies, even they've put out a note and they believe that the recent correction that we saw is much healthy and not like a meltdown. In fact, they see strong capex makes several mid and small cap attractive at this point in time after the recent correction. Similarly, if you look at the JP Morgan note, even they say that a 5 to 10% downside could be possible, but high exposure to sectors like manufacturing, infra, green energy can offer very high alpha opportunities going forward. So that's the Jefferies note. However, there are some not so bullish notes as well. So Bernstein put out a note a few days back. They believe that valuations are still rich after the recent correction, and it's going to be tough here to create alpha in the broader markets, and they prefer large caps over mid caps. So that's the broad view from the market. I just want to leave with few stocks which have done really well, but the valuations are stretched. So one needs to be careful in terms of stock picking as well. Look at these names: IRFC, REC. IRFCs are 400%, but now the valuation looks quite stretched. So is the case with REC as well. The stock has rallied almost 300%, but now it's trading at close to 1.5 times price to book versus just 0.6 times the 5-year averages. Even if you look at the likes of Hudco, Ircon, and Cochin Shipyard. Look at Cochin Shipyard. The stock has rallied 300%, but now it's trading at 77 times on current year PE versus their average of 24 times. So while the broader markets, some stocks may do well, one needs to factor as to where the earnings are going to be strong, because only on valuations, so many of the stocks look stretched and may not bounce back sharply in this challenging year.
Okay, well, Nilesh, your thoughts on small and mid caps? It's a tricky terrain, right? Because somebody wrote to me the other day saying that I'd invested in small and mid cap stocks, and all the gains that I accumulated in 1 year was wiped out in 3 trading sessions. So it's tricky. What would you do? I mean, at a time like this?
No, I clearly believe that you have to be in quality in mid and small caps. There is really no kind of salvation from that. You need to own quality and you need to own growth stocks, especially where you're really confident about the earnings outlook for the next 2 to 3 quarters, at least, if not more. I think for rest of the year and more so for the next 3 to 6 months, one will have to really be watchful of 2 things. One is, how does crude behave? How do commodities behave? I think the big story in mid cap, small cap has been margin expansion, which has driven earnings. If commodities, the way they're raising their head right now, the kind of strength that you're seeing in commodity prices, the strength you're seeing in crude oil, copper, aluminium, steel, all of them, you're seeing a lot of strength out there. It means good for producers, but honestly very bad for the guys who are buying them, who are consuming them. I think that's the one caveat out there. The second is, what exactly does the US Fed do with interest rates? The markets are pricing in 3 rate cuts this year. If commodities are going to go up, there's going to be inflation. If inflation is higher, will the Fed be able to actually do 3 rate cuts? I don't know. Okay. These are some of the kind of questions that will keep haunting us for rest of the year. And to that extent, a lot of this whole risk on, risk off will get driven by a couple of these factors. I think if these factors play out well enough, I think mid caps, small caps will be a great place to be in. If not, they could probably kind of give you less returns versus the large caps this year.
Nilesh, would you play some of these metal stocks though? As you said, there has been a big recovery in copper prices. Steel is showing some signs of coming back to life. You have iron ore prices that bounced from $100 per ton to around $110 per ton. Would you play any of these themes?
So we own one steel company. This is after a very long time we have bought a steel company.
One of the larger ones?
The smaller ones.
Small ones.
We've just kind of bought it about 3 months ago. I think it's done well in these last 3 months. Looks poised to be in good times. I'll tell you what, Nigel, I think what the investment thesis is around steel. I probably go back to 10 years ago when, chemicals, nobody wanted to look at chemicals 10, 12 years back. The likes of Atul and all that were probably trading at some 8, 10p multiple. And suddenly over the last 10 years, from chemicals, they became specialty chemicals. Okay, and that led 10p going to 30, 40p, depending upon what kind of specialty chemical you were making. It's quite possible that steel could go through a similar cycle. The big boys, of course, will keep making the generic steel, but I think the smaller steel companies, they can probably make some kind of special steel which will go into aerospace, automotive, defense, that kind of stuff, where they could have better realizations, better margins, and all of that. Pretty much like what we discussed earlier about technology, but if you're smaller, you'd be able to deliver specialized solutions. I think something similar probably may happen in the steel side.
Okay, well, let's do one thing. Let's take a short commercial break. Lots more coming up on the other side with Nilesh Shah. And we'll also talk about all the cues that you can watch out for next week in just a bit. Stay tuned.